You know, it's a shame that we don't have a larger audience, because I'll make a promise to you right now. When you leave here, you'll agree this was the best and most useful business-related seminar you've ever attended. And I'll tell you that because we've been doing this since 1975. And in fact, the very first lawsuit in America that involved asset protection was in South Dakota in 1962. The attorney who runs our company, or attorney who founded our company, won that lawsuit. So we've been working with the major companies and major people in America for many years. In fact, our clients include Marriott Hotels, which is this hotel here, New York Yankees, Oprah Winfrey's staff, Arnold Schwarzenegger, pretty much a who's who of everybody. And the reason is, way back in the 1960s, you only got sued if you were wealthy. But over the years that changed, and by 1975 we had our first call to do a presentation. It was for a group of doctors here in Florida that were worried about malpractice. Today we speak to every trade group in America, do many of the universities, and in fact, the University of California has a spectacular master's program in entrepreneurial studies. They now incorporate all of our materials in that program. They said nobody should be in business in America without knowing what I'm going to show you today. And what I'm going to show you today, your attorneys and accountants don't know. It's a strategy based on very solid rulings through the IRS and everything else. In fact, I'll give you the codes that go with it. In the short time together, we're going to show you how to become invincible to lawsuits, which is actually a very easy thing. Go ahead and take a few, and someone go get them. How to become invincible to lawsuits. Lowering your taxes is a byproduct of it. In fact, I'm going to give you a test to give to your accountants that, as you'll see in our case study, this individual lowered his federal taxes by nearly 20% by doing one thing his accountant wasn't aware of, and yet he had the tool in place. The accountant just didn't know how to use it. So we're going to give you a test to give to your accountant to determine whether or not you're paying too much in taxes. And then we'll spend a couple of minutes on the estate side. We have such a tight time frame here that we don't have time to go into a lot of it. There's a lot of strategies to use when you pass a business on or you leave it to somebody else. I'll only touch on the most important one of the whole group, and I will stay afterwards and answer questions. So to help us stay on time today, you guys, there's brochures back there. You'll all, oh good, well, yeah, hand them out to them if you would. To stay on time, please make sure you've got your phones off, broken, smashed into little pieces, whatever works best. Because if your phone goes off during the program, we'll all stop and wait for you to finish your call, because we're just real courteous like that. We also, if you have any questions, if you'll keep them till we're done, I'll stick around and answer questions when we're done, because you will have questions. There was notepads and pens in the back. Also in the brochures that you have, just a quick note about the brochures, we won't use them a lot, but this is a real handy tool to take with you when you leave here today. You're going to discover as we go through this, you're going to wish your spouse had been here, you're going to wish your business partner had been here, you're going to wish that somebody else that you care about, maybe a parent or somebody, had been in the room. So this brochure is a nice tool to wake them up. Also, the second to the last page in your brochure, there's a tab for a free report. If you guys fill that out at some point today, we'll send that report to you. It's a really good thing to hand to somebody who wasn't here. It doesn't give them solutions, but it says, hey, you need to pay attention to some of this. So let's dig right into what we're doing. I want to keep us on a really tight time frame, try to finish us at 4 o'clock, which is your time, and then stick around and answer questions. So here's the very first point, and I want to ask you this question. These are just some of the legal documents used by businesses today. Before you went into business, how much training did you have in selecting and applying the right legal documents? It doesn't matter if I'm speaking to the ice cream distributors, or I was speaking to the National Association of Realtors convention in Boston 2 days ago. I'll be in Atlanta tomorrow. It doesn't matter who we're speaking to. The answer is the same. You can't learn it because if you go to college, you're taught by tenured professors who are not business people. And the legal profession has no interest in helping you learn anything about the legal stuff. In fact, think about this. Did you ever go into an attorney's office and come out smarter than you went in? They're not in the education business. They're in the business of selling forms. So in the legal world today, virtually every legal form you use is a standard form, because it takes years to get the language through the courts. So when you go to an attorney and you say, I want a corporation or whatever you want, they just look at the clerk and say, print it out of the computer. So we all have standard forms. But here's the problem. If you do go to an attorney or an accountant and you get legal documents, and then you go to court and lose, who suffers? You or the attorney? You do. So if you're not managing the legal side of your business, you're only managing half your business. And the legal side is going to determine what happens when you decide to sell the business, what happens, how fast you're going to retire, whether you're going to win lawsuits or not. When you leave here today, you'll have a very specific plan in place. We're going to do a case study, and in the case study, you'll be able to take the pieces of it, see what applies to your company, take it back to your accountants and your attorneys if you want to. And obviously, we do provide services, and I'll explain those a little bit later to you. For some of you, they make a lot of sense. Some of you just don't need them. But let me start right up here at the top with joint tenancy. Most dangerous way to own an asset is in joint tenancy. And people will say, well, I don't have to worry about that. I got my S Corp, I got my C Corp, I got whatever else I need. And then one day they drive the family car into work, and for lunch they decide to buy pizza for the staff. They throw the car keys to an employee. The employee goes out and has a couple of beers while waiting for the pizza, has an accident on the way back, and you lose your business. In America today, the courts will use joint tenancy to penetrate pretty much every legal document you've got. So one of the first and most important rules of being in business is to isolate the business and keep it away from anything else that you have. So we'll talk about that in a bit. We won't talk about tenants in entirety. That's only in a few states. Sole proprietorship is obviously by yourself. How about a C Corp? Anybody here have a C Corp? Oh, good, a couple. C Corporation is the longest running corporation in America. It's been around over 200 years. And if you put it all the way back to England, it's been around over 500. It has by far, and it's not even close, it has by far the greatest tax advantages of any legal document we have. How about an S Corp? Who has an S? See, now more hands went up. And if I said, well, how did you decide to have an S instead of a C? Well, my accountant told me I needed to have an S Corp because I'm a small business, and his tenured professor in college said, if you have a small business, you got to be an S. Nothing wrong with an S. It does have some advantages, but let me offer you this thought. If you wrote a large check to the IRS in June, or in April rather, and then you sent off a large quarterly in September, and you don't have the benefits of a C corporation, you got to have a conversation with your accountant. But I'm going to show you a strategy today most of your accountants are not aware of. It is the single most important tax strategy in America, used by virtually every major corporation, every wealthy individual in America. That's how to get all of the tax advantages of a C corporation without ever creating one. Incredibly critical strategy. In the case study, he lowered his federal taxes by 20% because his accountant had misinterpreted what he did. So I'll show you that a little bit later. How about an LLC? How many have an LLC? Yeah, see, everybody's hands goes up. They give these out at Starbucks now, don't they? Like you order a grande latte in an LLC? Is that the way it works? So I kind of like to diagnose things so we know what we're talking about. So let me just ask you a very simple question and throw out whatever comes to mind. What do you think the purpose of a limited liability company might be? This is a live presentation. To limit your liability, right? Has nothing to do with it. The LLC was created in its current form in 1996 to solve the problems the S Corporation has created. Only 7 states currently have laws protecting an LLC in court. That means they have case law, they've already had judgments. In every other state, it's a mystery. It's whatever the court decides is what's going to happen. But now for those of you who raised your hands about an LLC, I want to give you a homework assignment, and it'll be a very, very critical assignment. When you go home, open up your LLCs and go to the 2 series paragraphs, 2.1, 2.2, 2.3, because I don't know if you got it from your attorney who got it on a CD, or if you got it from LegalZoom or some other service like that. Virtually 100% of off-the-shelf LLCs in America, there you go, excuse me, and by off-the-shelf we mean that your attorney got it off the CD or got it at LegalZoom. Virtually 100% of LLCs in America that you got off the shelf has a clause built in that guarantees if you go to court you lose. Now that's probably not what you had in mind when you got an LLC, but let me give you the words that mean it. Look for the 2 series paragraphs, a paragraph that's about 7 lines long. Look for these 2 words, mandatory distribution. Just pick those 2 words out, mandatory distribution. What that means is every year you have to distribute all of the cash in your LLC. So if you get sued, they go after the money, you have no way to stop them. Now I'll show you how to repair that, but the point here is very simple. If you have a legal document, you expect it to perform in a certain way. And if it doesn't, what's the point of having it? So we're going to talk about that specifically. We are big believers in doing the most you can do with the fewest possible legal documents, but make sure they're right. So basically, how many of you here have employees? Good, okay. And I'm going to assume when you got your employees, you gave them a job description, written, verbal, whatever. Did you do that with your legal documents? If you didn't, you're only managing half your business. So what we're going to do today is help you give a job description to the legal documents you have in your business. The last one's down here, the limited partnership, will, living trust, etc. The limited partnership is a foundation tool for all asset protection in America. It won the lawsuit back in 1961. Today, we can take a piece of that partnership, put it in the LLC, and do things a whole lot cheaper and a whole lot easier. I'm going to talk about the will and living trust in a couple of minutes because right now, the largest transfer of wealth in the history of America is occurring as baby boomers pass on. And their wealth is going not just to the IRS or not to the feds, it's going to the legal system. And the legal system has a vested interest in making sure that you don't plan properly when you die. So for those of you in here who are younger and you have parents who are alive and they filled out a will maybe 10, 15, 20 years ago, and they think it's okay, we're going to show you what you have to do today. So very simple process, very good to know. So let's move forward. Threats to wealth in America. The number one threat to wealth in America is lawsuits. So a real simple question. What is it that motivates an attorney to sue you? Money, right? See, this is still a live presentation. So money. Well, what if you could take the money out of the lawsuit? What happens then? What if you could go one step further? What if you could say to the attorney, if you're stubborn enough to continue with the lawsuit and you're unlucky enough to win, it's going to cost you? What happens then? This is what companies like Marriott do. And think about this today. We're in a Marriott property. Turnberry is part of Marriott. Can you think of a higher risk business than a hotel? I mean, everybody who walks in and out of the door every day of the week is a potential lawsuit. You could never operate the business. And then all of a sudden you've got hotels in all 50 states and of course overseas. So you may go to court in Florida and have a decision, go to court in Wyoming, go to court in Wisconsin, go to court in California for the same thing in all 4 states and have 4 different decisions. You could never run a business if you couldn't predict what's going to happen in all 50 states. So that's the main point we're going to show you today is how to make sure that we protect ourselves from all 50. And think about this too. If an attorney walked into the room right now and said, hey, I have a summons to court, wouldn't it ruin your day? Because you don't know what's going to happen. So let me change the question. If an attorney walked into the room today and said, hey, I have a summons to court, wouldn't you rather have him hand it to the person next to you? Find out who your friends are real quick, don't you? I call that brushing your teeth legally. That's saying to an attorney, you can check me, you can look the public record, but don't bother coming after me. There's nothing here for you. Go on to somebody else. We are the most litigious society in the history of the world. We have 4% of the world's population in America. We have 90% of the world's lawsuits. That's a pretty staggering number. It's over 100 million a year. So the legal profession just goes after the easiest people to sue. And if I was an attorney right now and I walked into this room and said, hey, I want to sue somebody in here, how do I decide who to sue first? Whoever's got the most that's easiest to take. And I would assume that as we sit here right now, pretty much everybody in this room is one bad judge's decision away from starting over. That's a tough way to run a business. So instead, we're going to do what, like as I mentioned to you, Marriott uses our strategies. Also mentioned the Yankees. Now think about this. Yankee Stadium, 50,000 people drinking beer for 9 innings. How much liability is that? You could never stay in business if you couldn't bulletproof your assets. American Airlines, I mean, pretty much a who's who of anybody who's in business. All we want to do is exactly what they're doing to prevent themselves from worrying about lawsuits. It's the reason we have franchises in America, the reason we can expand is because of what I'm going to show you in a little bit here. Also, the second area is taxes. Now, I don't know any of you, I don't know where you're from, but how many of you in here feel you just do not get to pay enough in taxes? No hands. So the truth is most people in business in America give their wealth away time and again throughout their career because they pay too much in taxes and they do it on the advice of their accountants. So again, I'm going to give you a test. I'm going to give you a test a little bit later to give to your accountant to determine whether you're paying too much in taxes. And in fact, in the case study, this accountant changed his entire practice and now does this for everybody. So it's a very important part of what we do. Then let's go to the third part. Let's talk about probate. This right now really is, despite everything else you hear everywhere, really is the greatest challenge we have in America today. So you march down to your attorney, and you say to your attorney, look, we have finally come to grips with the fact we're not going to live forever. So we need to make sure when we die, everything goes exactly to the kids. And the attorney says, that's easy enough. If you want everything to go to the kids, all you got to do is fill out a will, right? Now, we have a different definition of will. It's 2 words instead of 1. Attorney, welfare. If you have a will, your estate must be probated. Now, let me give you my definition of probate. Probate is a process in which you look your family in the eye and say, hey guys, you're my family, I love you and all that stuff, but when I die, I do not trust you to make any decisions. Now, I do trust that attorney and that judge you've never met. And I trust them so much you can't have anything till they give you permission. And the longer it takes them to get you permission, the more I'd like you to pay them. And oh, by the way, whatever you owe them must be paid in cash before probate can close. Can you find anything good for the family in there? Probate fees in America average, and just put this in your own mind, I don't know the value of your estates. Probate fees in America average around 10% of the value of your estate. That's a staggering number. That means the legal profession and sometimes the IRS or whatever else is involved is going to take 10%. Some of you live in states, and I know this because we do these programs in all 50 states. I'll hear it when I'm driving around. I'll hear law firms advertising on the radio, you need to get a will. Why not? It's guaranteed income. There's a better way to do it. So, and by the way, let's say that your personal estate's $1, $2, $3, $4, $5 million. You got your business, some rental properties, whatever it may be. And probate fees come out to be $30, $40, $50, $60, $70,000. Just depends on the skill of the attorney. What if the kids don't have the money to pay the probate fees? What do? They probably sell an asset. So let's say now you had a little rental property or whatever it may be. If they sell an asset, they're going to get hit with a tax. And what tax is that? Capital gains, and how much are they? You hear the silence? Now, it's not just you guys. I mean, it's every group we deal with. Capital gains are really confusing now. They're between 25 to 28%. They're on a funny scale. But this means if you were to pass away today, and for those of you who are younger, your parents are thinking you're going to get everything. You pass away today, everything goes into probate. About 10% is bled off through legal fees, and another 25% for capital gains. What's happening to the estate you thought you left to your family? But it's worse. Probate is a public process. The second you die with probate, everything you have is published. 100% of what you have can be contested. So you may have a will that says, look, this car is going to child number 2. It's not. The attorney's going to determine who gets it. So the will can work fine in some cases if you got a little tiny estate, nothing else. But probate is a process that I call chaos because you don't have any control. It's strictly the legal profession. And they've got a vested interest in dragging it out because the longer it goes, the higher the fees. So wouldn't you all agree that the first thing we'd like to do is eliminate probate? If we eliminate probate, we eliminate the costs, the delays, and all that. There are 2 ways to eliminate probate in America today, and they both work really, really well. The first way, live forever. It's worked so far. But the real way you eliminate probate in America is with a legal tool that everyone in this room should have. There are no exceptions. A revocable living trust. The revocable living trust may be the most useful and versatile legal tool we have in America. The keyword here is revocable. Some of you may have an irrevocable trust. That's one you can't change, so we're not referring to that at all. A revocable living trust wants to know who are you, what's the stuff, and who do you want to give it to. And when you're done filling it out, you stick it in a drawer. It doesn't have to be filed and does not have to be recorded and does not require a tax return. You want to change something in it, you just cross off what's in there, put the new thing in. What people do today is typically in the back of the revocable living trust, there's a Schedule A. It's just stuff you can list. They'll simply list everything that goes in there and they'll just take a picture of it so that they have a digital picture. Then when you pass away, everything goes directly from the trust where it's supposed to go. It bypasses the legal system, keeps it out of probate. So the revocable living trust is a tool that everybody in this room should have, no exceptions. If you have been married more than once, you got to have one for the husband, you got to have one for the wife. Because if you ever met somebody who said, oh yeah, you know what, I was married before, but if I die, my former spouse doesn't want anything. What happens when you die? The battles start. So if you've been married before, a revocable living trust for the husband, one for the wife, and both revocable living trusts say that the survivor keeps 100%. That eliminates any claims from the other families. You know, I've known people that have been married 3 or 4 times, and it's the kids on the 4th level or something that want to contest everything. Probate never ends, the attorneys get wealthy. But if you have a revocable living trust, that puts a screeching halt to that. So on a selfish level, if you're in position now where you're going to inherit something and your family's got a will, you got to stress to them that there's no possible way that they can guarantee you'll get anything. You just don't know. We know the court's going to determine it, not you. So make sure they're well aware of that, and for yourself, the revocable living trust. Now with that said, and I always apologize for going so quickly, we're in such a short time frame here, I want to cover everything, but we originally got involved in speaking to trade groups because of the issue of lawsuits, which just in some cases is so out of hand in some states that businesses sometimes just throw in the towel and say, never mind, I don't want to be in business. Right now, divorce is the #1 cause of lawsuits in America. Now, I have an attorney friend in San Diego who's got a bumper sticker on his car, says marriage is grand, divorce is 100 grand. So divorce can be a big problem. So what if you're getting married, what if you're going to get divorced and you say to your soon-to-be former spouse, look, I don't mind giving you some money, but I don't want you in the business. How do you keep them separate from that? But let's talk about a couple of other things real quick. Let's say that I come near your equipment or I come in your store or whatever you have and I fall down and I injure my knee. How long do I have to sue you? These are pretty fundamental questions. Well, most states it's 18 months to 2 years, but the clock doesn't start till I discover what went wrong. So I fall down today, 10 years from now I go to a doctor, the doctor says, well, it looks like you damaged your knee. Oh, I remember I fell down in near the ice cream truck. And all of a sudden the clock starts then. This is what drives business owners crazy, is how do you prevent that? Well, I'm going to show you how to prevent that. There are other things, I mean, we understand some of the basic things like employee lawsuits and that, but what do most businesses buy to give themselves some protection from lawsuits? Insurance. So now I have a question for everybody. How much insurance is enough? Isn't that an interesting question? And isn't it fair to say that insurance is actually, all you're doing when you buy insurance is you're admitting you're guilty, you're just trying to set aside enough money to pay? Isn't that what insurance does? Because it doesn't prevent lawsuits. In America today, the more insurance you have, the faster you get sued. There's a lot of law firms in America today that don't go to court, ever. They just send out threatening letters to people and they can get paid just based on the threat. So it becomes a real problem for us. And by the way, some of you may have accountants or attorneys who said you need to carry umbrella insurance, and it's a good idea, it's pretty cheap to do. So you have $2 or $3 or $4 million of umbrella insurance. What was the average award in a lawsuit in America last year? Anybody know? $5.2 million. Now it varied. If you're in Ohio, it was over $10 million. If you're in South Carolina, it was under 2. So it just depends on where you are. And if you're going to carry insurance, you need to know that it works. But I'll give you an alternative. We would rather have you carry the minimum insurances you have to have, but lower them to the minimums and put into place the legal tool that will prevent the lawsuit damage in the first place. And that's what we're going to work on right now. For the next 10 to 15 minutes, I'm going to change everything you ever thought about the way your business is structured, and many of you are going to take this back to your accountants and attorneys and you're going to change what they do. Because the fundamental thinking of what we do in business just has some really incredible errors. So first of all, methods of ownership. Now I'm going to make an assumption here that most of you have your business, then maybe you have some rental properties or a motor home or a vacation home, you have other things that you own. And we want to isolate those. And just to think about this, there are a lot of people in business who go into business to accumulate other things. And those other things over time are what's important to them. But if they get sued for the business, the other things go. So how do we separate the personal side of your business? And I'm going to show you how to do that. First thing here, C corporation is for management, or CRNS, for management and taxation. What word is missing from that definition? Ownership. In America today, you would never, under any circumstances, allow a C or an S corporation to own an asset that could be at risk in a lawsuit. How many of you remember Enron Corporation back in Houston in the 80s? The first thing they lost was a 52-story office building owned by the corporation. That was the end of corporate asset protection in America. So today you let your corporation manage. And think about this. Here's a really good thing to think about. Let's say you were going to go to an attorney today and you say, I think I need a corporation. There's only one question. to ask an attorney when you get a corporation. Since all corporations can manage, the only question is which one's best for me tax-wise. That's it. So if you've got a C or an S corporation today, it should manage the business, but it should never, under any circumstances, own an asset that could be at risk in a lawsuit. Now, we'll show you how to break that out in a little bit. This is the first big eye-opener for a lot of people. In our case study, this guy had an accountant who basically said, well, you ought to put the other stuff in your name. So he had quite a bit of assets all in his name, which is just financial suicide. The second part here is the asset protection comes from the limited partnership or the LLC. Now, the limited partnership has been around over 100 years. It won the very first lawsuit in America. So, and I'll show you this in a little bit. I'll show you exactly how Marriott owns these properties. But the limited partnership is the strongest asset protection tool we have in America, but it also requires tax returns and filing. It's kind of a pain to work with. The LLC, when it's done properly, can take a piece of the partnership and do the same thing a lot cheaper. So today we use the LLC for the benefit of protecting our assets, and also, as you're going to see a little bit later, when the LLC is structured properly, it is without exception the greatest tax tool ever created. There's nothing close to it. So, for example, I don't know where they keep their ownership papers here in the hotel. I tried to look, but you can't get in the lobby. But most Marriott hotels, the originals, now this one is, because it's a resort, it's part of their collection. It's a different type of property. But if you go into a normal Marriott or JW Marriott, there's usually a gold plaque behind the counter or in the manager's office. And at the top of it, it says managed by the Marriott Corporation. And below it, it says owned by the Marriott Limited Partnerships. If we were stopping right now, I've just given you the most sophisticated asset protection plan in America. See, most people think when they hear about doing stuff legally, it must be really complicated. It must be really impossible to understand. It's not. Let your corporation manage, but let everything you want to protect be in a properly structured LLC. And we're going to look at that and look at where we're going to put that, because this is the other part of this. Now, you guys are from different parts of the country, so I want to ask you a question. How many of you here have heard of corporation states? You know, this is the most important part of owning and operating a business in America, and unfortunately your local accountants and attorneys just aren't aware of it, but it's used by every wealthy family, every major business in America. What if I told you there are certain states that said you can put your equity in those states, and if you put them there, they'll be immune from lawsuits? Wouldn't you think that was a pretty good idea? Now, we're not saying move there. You know, if you've got a business or you've got a piece of real estate, you got to have a deed or you got to have a title to that business, where you live, where it's located. But your equity, your ownership, can go anywhere you want to put it. And if I said, well, you could put it somewhere where it's protected, you'd say, that seems like a pretty good idea. Well, that's what Marriott does. Marriott would never, under any circumstances, have the ownership of their hotel, this building in Florida. Financial suicide, they would never do it. And they couldn't do it. So let me show you what states we're talking about here. There are 4 corporation states in America. We call them asset protection states. They are Alaska, Nevada, Wyoming, and Delaware. Your at-risk assets go there. So let me touch on this real simple and narrow it down. If you're on the East Coast, most of your attorneys have used Delaware for years. Now, nobody else does because Delaware is more expensive. Got a lot of problems, but here's the rule, and this will probably eliminate about half of you. You would only use Delaware if your business is $500 million or bigger. Does that cut out about half of you? So Delaware's for the big guys, for the Monsantos and the DuPonts and the General Motors and the big players. And as you can see there, 60% of Fortune 500 companies have a Delaware headquarters. That's staggering. Now, they're not in Delaware. You don't have to be there. They have what they call resident agents in these states. A resident agent is someone who is registered with the state. And let's say you're sitting here today. Let's say you did own this hotel. Say, well, I want to protect my equity. So let's say you've got 95% equity in the Turnberry Resort. All you do on that LLC is you write in 95% equity on the Turnberry Resort, and you send it to that state where it's filed. That's it. It's a very simple process. Now, Wyoming is the most interesting state. If you live in Florida, Texas, Oklahoma, Kansas, Iowa, or South Dakota, you can't lose your home in a lawsuit. In every other state, you can. So as you're going to see in the case study, this guy was in Indiana. He had a home worth $2 million that was paid for, scared to death. He was going to lose it in a lawsuit coming on. We've had people in every state who said, look, what I did with my equity was I bought a big house, and I mean, it's great, but I don't want to lose my home. So we don't see it a lot. If you have a mortgage on your home, you don't have to worry about that. But basically, Wyoming would only be used for your home. Alaska and Nevada, however, 60% of Fortune, or 90% of Fortune 100 companies have a Nevada headquarters. Isn't that staggering? That's tens of thousands of companies. Well, why do they have it there? Well, let me explain to you exactly why in a minute, but first I want to ask a question. This goes back to May of last year. See how many of you remember this. How many of you remember the Panama Papers? Recall that from last year? Some of you just think, I don't know. The BBC discovered that the King and Queen of England had set up Panama corporations for their assets. And of course, the BBC then threw a 2-week fit. Well, CNN discovered that the BBC had discovered that, but CNN discovered that virtually every wealthy family in America, tremendous number of people in Congress, and the owners of many big companies also have Panama corporations. And of course, they threw a big fit saying they shouldn't do this. But then when you read the article, you learned that 98% of Panama corporations have a Nevada headquarters. Well, there must be a reason. So let me give you the reason in very simple terms. Let's say that as a group, you decided you wanted to sue me. So you hire a very high-powered attorney, and he discovers that my corporation, which mine is in Nevada, he discovers that my corporation is in Nevada. So he calls the state of Nevada and he says, I want to sue ABC Corporation, that's Larry's corporation. And Nevada says, well, yeah, it's here. He says, oh, that's great. Okay, and I want to sue Larry too, he's the owner of the corporation. Nevada says, well, you can't. You see, he's not here. His corporation's here, but he's not on the record anywhere in the state of Nevada. He's not affiliated with this company. Well, first of all, what does the attorney say? If he can't find you, he's just going to go on to the next person. But listen to what else Nevada says. Nevada says, by the way, if you do decide to pursue this lawsuit and you end up winning, we're going to punish you and your clients financially. Now what do they say? Say, never mind. This is the key to total, complete asset protection in America. It's just allocating what you have. So think about this. Just in the back of your mind, what do you own that under no circumstances do you want to lose in a lawsuit? That should be in either Alaska or Nevada. Now, we're using Alaska more today than Nevada. And again, you don't have to go to those states. You simply mail your information to the resident agent. They file it. It's a few $100. It's not very expensive to do it. But there's other reasons to do it too. For example, I live in California. We have the highest state income tax in America at 13.3%, depending on today's election, going up again. The state of Washington just added a huge one to their people there. Well, I own property in California, I own property in Arizona and in Oklahoma. I could never, ever operate a business in California, not at 13.3% tax. So I have a Nevada corporation. I think they're trying to get out. They've been locked up all day back there now. So they are, aren't they? You can tell. Get a little paranoid up here in front. Yeah. So if they get too bad, we'll go knock them down. But anyway, so now you set up your corporation in a state like Nevada, and you're pretty well bulletproof from what happens. And the key to this is that when you set up your corporation, the state of Nevada has got a lot of years of history behind it, and now Alaska's popped onto it, Wyoming's into it, and Delaware's been in it for a long time. So all you do is you send your document to that state. Well, as I mentioned, I've got 13.3% state income tax in California. So my business is managed in Nevada, which has 0% state income tax. So all of my tenants pay their rents to my Nevada corporation, which then charges me an outrageous sum to manage all my business. It's a horrible amount of money it charges. It really abuses me. And so the money that comes back to California is a fraction of what it was originally, and my state taxes go way down because of it. So there are a lot of people that use Alaska and Nevada for state tax reasons. Now, some of you may live in states that don't have state income tax. In that case, you don't worry about it. But the point here is that setting up a corporation in one of those states is pretty easy to do, and it's not very expensive, and it's used by, look at the number of companies here. I mean, it's a staggering amount. So now let's talk about how we put this together. So if we're going to do it, what does it look like? And here's what's really going to open your eyes to something that's very simple and makes all the sense in the world. If you set up a limited partnership, or attorneys will call it a family limited partnership, that's why it says FLP, we are going to use the LLC. Now, in the case study we're going to do in a couple of minutes, that guy used a partnership because that was 10 years ago. The nice thing about the LLC is it's only been the last 3 or 4 years that we can do what we want to do with the LLC. It's just really coming into its own. It's doing really, really well. But now when you set up a limited partnership or an LLC, you got to have managing partners, you got to have general partners. These are the boss. Now here's the rule. The managing partner or the general partner is always 100% in charge. They could own 1%, 2%, 90%. It doesn't matter how much they own, they are always 100% in charge. So if you're going to set up an LLC, who gets to be that managing or general partner? It's going to be you, right? Because you want to be the one running your business. Now you also have to have limited partners. Now the limited partners never get to have a say in anything. They could own 99% of it, 80%, 70%, it doesn't matter. They don't get to have a say in it. Before you decide who gets to be your limited partners, let me show you what the IRS says. The IRS says the limited partners do not have to be human. I was up in Boston Saturday, and one of the guys said, oh good, then my lawyer can be my limited partner, which everybody thought was a really good idea. But if your limited partner doesn't have to be human, who gets to be your limited partner? Could be a corporation, could be something else. You know, a lot of people say, how about the dog and the cat? Well, the IRS can't figure out how to get the dog and the cat to open a bank account and pay taxes. But any other legal entity you have can become a limited partner. So now I want you to think about this. Let's say that we said, okay, we're done, we're stopping right at this point. When you go back home, you take your control, the letter C for a corporation, think of control. That's your management. Whatever you have in place today, your C Corp, your S Corp, or whatever's running your business, it becomes the dictator. But anything you want to protect in a lawsuit goes down here as a limited partner. And in a second here, I'm going to show you why that is and why that's such a powerful point. But the point here is real simple. Whether I own one property, if I own my business, or what if I own my business with a partner? What if you have your business building and you've got a partner and your partner gets sued? How do you keep yourself out of that? And I'll show you how to do that also. So we find in our small business groups, most of our audience has wealth between 1 and 5 million. Sometimes it's more. I mean, you may live in a state where the value of land has skyrocketed over years and the family's held on to it and now it's worth 10, 15, 20 million on paper. You don't feel like a millionaire otherwise. But also, you maybe own some real estate, and maybe you own it with a brother or a sister, they're managing the property. If they get sued, how do you keep your property out of it? So how do you keep your equity protected from everything? The key to asset protection is you've got a 100% bulletproof what you've got, then you can worry about everything else. So you got to take care of your own first. So now let's talk about what happens if you go to court. Let's say that you've set up this very carefully crafted LLC and now you go to court. Well, in a traditional lawsuit, if you go to court and you lose, they issue a judgment, and then the attorneys come and get something called a writ of execution, and they take all your stuff. As we sit here right now, pretty much everybody in this room is one bad judge's decision away from starting over. It's a heck of a way to run a business. But now you set up this very carefully crafted LLC, and you've got two types of assets. You got your stuff. You got your real estate, you got your motor home, you got your airplane, your boat, you got your land that you lease for hunting or whatever it may be. And it's worth $2, $3, $4, $5 million. You've also got your income, $50, $60, $70, $80, $100,000 a year. And you say, look, if I go to court, I don't want to lose either one of these. But how do I absolutely not only prevent losing them, how do I keep them out of the lawsuit in the first place? So the first thing that happens here is in a traditional lawsuit, if you have this very carefully crafted LLC, the judge can still say guilty. The judge can say guilty, but cannot issue a judgment. What governs it is called a charging order. Now, this charging order goes all the way back to the lawsuit in 1961, and it was reaffirmed in 1977, so it's cast in steel. So I want you to follow me through with this. And I also want you to know, if an attorney comes to sue you and fails to do due diligence, and then the judge says guilty, it's too late for the attorney at that point to say, oh, never mind, we're going to drop the lawsuit. Their clients are going to suffer. So follow me through and tell me who's going to sue you if you've got this provision in your LLC. Under the charging order, they cannot touch your assets in all 50 states. They can't take your buildings, they can't take your real estate, your boats, your airplanes, they can't take your paintings, your grand piano. They can't take a single asset that is covered in this very carefully crafted LLC. So if you've accumulated over the years $2 or $3 or $4 million of assets and they can't touch it, do you think that would slow down lawsuits a little bit? That'd make a big difference, wouldn't it? But for those of you who already have an LLC, here's the problem I told you about earlier. You have that clause that says mandatory distribution. They can take all of your money. So now they can't touch your $2 or $3 or $4 million worth of stuff, but they can take your $50, $60, $70, $80,000, and they leave that decision on the books and take your money year after year until they're paid off. Well, that takes a whole lot of the fun out of it for you. So way back in 1961, we created a paragraph, which is paragraph 2.9 in our agreement, and it's going to give all of you a choice. So we're going to assume all of you have $50, $60, $70, $80,000 of income. The judge said guilty, so now you have to decide how much you're going to pay to that attorney and their clients, because here's what the clause says. The clause says the managing partner, that's you, reserves the right to withhold all distributions of profits. How much of your hard-earned money do you want to pay to the attorneys and the clients when the judge says guilty? Some of you need more time to think it over. How about zero? So now you're thinking, well, this is great. Look at this. Wait, they can't touch our stuff, they can't touch your money. But you still have one huge problem, and the problem was resolved by the last people you would ever expect to solve the problem. First, let me tell you what the problem is. You had profit in your agreement. When you lost the lawsuit, who's entitled to your profits? The people who sued you. But how much did you pay them? Nothing. But they leave the decision on the books. If you ever do take any money out, who does it go to? You're frozen. You're stuck. You can't do anything at all. That was a problem until 1977. And now listen, guys, if you're, they wanted to be in on it too. No, so if you're a kind of person who feels a little bit fragile at the moment, you might want to hide under your table, because listen to this. The IRS solved. Have you ever heard those two words in the same sentence? Because they're a domestic terrorist organization, aren't they? Yeah, the IRS doesn't do anything for you, but they solved the problem here. Because here's what the IRS did. The IRS looked at this and said, well, wait a minute. There was profit. We're the IRS. We are supposed to share in the good times. But you didn't pay them any money. They don't have any money. You didn't have to distribute any. There's no money to pay us. So we're going to fix it. In 1977, the IRS issued the 137th ruling of the year 1977. When they issued this ruling, the Wall Street Journal said this limited partnership, because the LLC didn't exist way back then, said this limited partnership is now the only A+ asset protection tool in America. Because here's what the IRS said. Listen to how simple this was. The IRS said, look, under our provision, we don't care what the court said. We don't care if you went to court. We don't care if you didn't go to court. The only thing we care about is there's profit. And if there's profit, we get paid, period. Who has to pay the IRS? Let me put the exact words of the IRS ruling on the screen, and then maybe you'll understand why Marriott and the Yankees and everybody else uses these provisions. The IRS says that the creditor, the person who sued you, now must pay income taxes even if no income is distributed by the partnership or the LLC. If you sue me and win, you get my tax bill. Now who's going to sue you? Do you see how companies can operate nationally? I mean, you think about it. You think of a big company, you think, well, how do these companies stay out of lawsuits? Why aren't they getting sued every day of the week? Oh, I'm sure they're getting paid under the table. But then think about this. If Marriott went to court and they lost a lawsuit for $5 million, what would they do? Take it out of petty cash, right? If you lost a lawsuit for $5 million, what would you do? See, I've always thought these strategies are more valuable to people like you and me than they are to the big guys. But the big guys already paid their attorneys millions of dollars to get this stuff through the courts. So all we're doing is piggybacking on what the larger companies do. And now let's put this together. Let's make it all fit. What I want you to do, after you look at this here, I want to talk about this. I want to make sure everybody has a brochure. If you do not have a brochure, go to the back table. There's some. I've got some up here, and somebody at another table will sell you one. So we're going to use that in a second. Here's the problem that we hear over and over from businesses we deal with. And that is that I have a really good family attorney, and my family attorney does my business documents and does my tax documents, does everything. And they're really in over their head, and I don't know whether I'm getting the best for what I've got. Even my accountant is giving me stuff, and many of you have accountants who believe, as the accountant in this case study did, that you ought to pay more in taxes to prevent audits. So how do you know what you've got? Well, let's do this. What I'm going to do is I'm going to take you through an exact case study. I'm going to ask you to pull out the parts of it that apply to you, take this back to your accountants or your attorneys, let them change the way they do business. Now, for those of you who decide to work with us, obviously we'll do this for you. But I want everybody to open your brochures now to the middle. You got a page that looks like this. Now, just to set this up, it's right in the middle of your brochure. Just to set this up, I spoke to the Indiana Dental Association in 2008, so this is 10 years ago. I still use the case study because his issue was so comprehensive and the result was so good that it really helps you out. Basically what happened was he had gone to dental school, graduated with a bunch of debt, went to work for the practice, and soon after he went to work for the practice, the original dentist said, look, I'm going to retire, do you want to buy the practice in a few years? He said, sure. So he got more debt. Then the dentist said, well, I'm going to sell the building too. Do you want to buy the building? He said, sure. So he got more debt. At the same time, he had several rental properties. He was the only survivor in his family. His sister had died years ago. His parents were gone. So he had inherited some of these properties. 3 were paid for. 1 was almost paid for. And then he bought a really nice home out by the Indianapolis Motor Speedway, and he said it's worth about $2 million. I bought it when the market was down. He said what happened was 4 years ago, the original dentist retired. So the next 2 years, I spent renovating the building, paying things off. We brought in other specialties like orthodontists and endodontists and perios and all that. And he said, we have a 2-story building, it's full, we have an extraordinarily profitable practice, really good practice. And he said, I pretty well have everything paid for. And then he said a couple of months ago, because I was there in June, so he said a couple of months ago in April, I got my tax return from my accountant. He said every year I was paying $20,000, $30,000, $40,000 because I made really good money, but I had all these write-offs. And this year, I owed the IRS $143,000. He said I just about fell over. So he said, I called my accountant. I said, how could it be so big? It's almost like 10 times what it was. And the accountant said, well, you had a really, really good year. He said, yeah, but I know, but still, taxes going this high? And the accountant said, well, you know what? You should be happy about it because the more you pay the IRS, the less likely you are to get audited. And he said, right at that point, he said, I was done. He said, I'm not buying another piece of property. I'm working for the IRS. He's paying over 30% to the IRS each year. You know, if you're at that level, sell your business. So he just said, I'm frustrated. What we did then was we set him down with his accountant, and this is the result. And he ended up lowering his federal taxes over 20%. Now, most of the people we see do this will lower their federal taxes 5%, you know, a smaller amount, but he was paying way too much. But let's take the pieces here. Right in the middle, the revocable living trust. I told everyone earlier, it is the one legal tool that you have to have in place. The revocable living trust decides where everything goes when you pass on. If you have it, it goes where you want it to go. If you don't, it goes where the attorneys want it to go. So the revocable living trust sits on top. You'll notice over there it says it owns the interest in everything. Basically, every legal document you have has a phrase inside it that says, when I die, when this document is gone, everything I own goes through the living trust. And then the living trust just tells who gets it and why they get it and all that. It's not a technical document. It's just writing down your life story and telling where things go. But now let's take the pieces. And as I go through this, if there's parts of this that don't apply to you, just don't worry about them. But the parts that do apply can save you a lot of money and a lot of headaches. The green box is an Alaska limited partnership. Now again, this was 2008, we had to use Alaska. Here's his problem. His parents and family were gone, but his parents and grandparents had accumulated rare coins and all kinds of really valuable collectibles. And he said, I have about $3 million worth of collectibles. And he said, it's all inherited. It's not part of the business, but if I get sued, they're going after it right away because it's easily negotiable. So he said, I want to protect it. So these are called safe assets. Definition of a safe asset, something you own that is never used in the business. So what do you have that's apart from the business? You don't want to lose it if the business gets sued. So we set him up in a limited partnership in the state of Alaska. Here's the ownership. He and his spouse were 1% owners as general partners. So if they're 1% owners as general partners, how much control do they have? 100% always. They are also 99% owners as limited partners. So an attorney comes along to sue him, and he looks and the attorney says, oh, this is great. The guy's a dentist. Wow, look at all these personal assets. $3 million worth of personal assets. He pulls the ownership document and discovers 99% of the equity is sitting up in Alaska. And if the attorney sues him and wins, what's the result? He ends up paying the taxes if there's a tax bill, and he can't have the stuff. What does the attorney say? Never mind. You can't get the attorney to take the case because attorneys tend to be pretty smart people. They're not going to take a case like that. So that's personal stuff. I've had owners who say, look, I've got a classic car collection. My 3 cars or my 5 cars, they're worth more to me than my business. Well, that's where those go. They sit over there, they're apart from your business. Then we come over here to the business itself. So for you guys, this is your basic business. This is where the income goes. So you sell something, you make some money, it goes through here. In his case, this was the dental practice. He had an S corporation because all dentists in Indiana have an S corporation. So whatever you've got, keep it, but give it a job description. Now, you'll notice it is filed in Indiana because he lives in Indiana, and all the income comes through there, but it doesn't own anything. The S corporation doesn't own the building. When we came to him, the S corporation owned the building. Huge mistake. But it doesn't own the building. It doesn't own anything. Just the money goes through it. Then we come down here to his home. Now this is what I told you earlier. We won't use this a lot. This is Wyoming. Wyoming is the only home that protects, or the only state that protects a home. If you live in Florida, Texas, Iowa, Kansas, Oklahoma, or South Dakota, you can't lose your home in a lawsuit. But everywhere else you can. He said, I bought this home out by the Indianapolis Motor Speedway. It's on 5 acres of beautifully manicured property. I've expanded it. It's worth at least $2 million, probably more. And he said it's paid for. He said, if I get sued, what does the attorney go? I don't want to lose my home. So he set his home up, the equity in the home, in the state of Alaska, and or in Wyoming, and we did it because Wyoming protects the home. But I want you to look at a couple of things here. You'll see it's filed in Wyoming, but look at the tax situation down there. Says it's a disregarded entity. This was the mistake that his accountant was making, and I've had people, every time we do a larger group, I've had somebody in the room say, that's exactly what my accountant has done to me. And sometimes you're paying a lot of money because of it. So let's go forward, and let's take the rest of this before we come back to that. Now we have the business real estate building. This is the building itself. So him and the other dentists all work in this building. So consequently, he's liable for lawsuits if a patient from one of the other dentists has an accident. Everybody gets named in the lawsuit. So he now has it in Indiana. It's filed in Indiana because it's in Indiana. The tax is identical, but look at the ownership. It's a management agreement. Now, a management agreement is personal property, and by definition can be filed anywhere you want to put it. So the management agreement is going to be filed where it's protected. But here's what you're going to discover as we go through this. Everything is the same. We've got more than one legal document, but they're all in Indiana because he's in Indiana. They're all disregarded because LLCs are all disregarded. So you don't have a lot of detail to learn about these. But now let's carry it a step further. Here is his business equipment. Now, in his case, it was x-ray equipment used by the other dentists, a lot of medical type stuff. In your case, this could be trucks. You may have somebody who drives trucks for you, multiple trucks out there. I'll give you an example. One of the companies that we've worked with for many years is a New York City taxi cab company. Now, any of you ever ridden in a New York City taxi cab? Yeah, so they're driven by a maniac who's been in the US for 38 minutes, and his only job is to kill you before you get to the hotel. Isn't that right? They drive they are so risky. The company we work with had 51 cabs, 51 drivers, they had 51 LLCs because they felt each cab was its own unique issue. So for example, if you had 2, 3, 4, 5 trucks, you might have each truck in a separate LLC to isolate that driver and the accidents that driver may have. But it's always up to you. It's just how you do it. You always separate your assets out. Some companies like contractors will have forklifts or other things, cranes or other big heavy equipment that people use. They'll isolate them. If you don't have any of that type of equipment, if all you've got is a Baskin-Robbins storefront, you really don't have anything to worry about with that. But down here was his equipment. Now again, filed in Indiana, disregarded entity, it's also a management LLC. So again, it's all the same. But now let's go to his biggest problem and where the biggest solution came. Over here, he had 4 pieces of property. Now when we came to him, listen to what his accountant had done. His accountant had said, he had gone to his accountant, he said, look, the other dentist in here said I ought to put my property in an LLC. And the attorney said, well, no, don't bother with, or the accountant said, no, don't bother. He said, look, it's a disregarded entity. Since it's disregarded, we just disregarded it entirely. There's no sense having the cost of creating an LLC. Well, he had it exactly upside down. Here's what disregarded means, and think about this. Disregarded means that LLC never has to file a tax return. You could have 500 pieces of property, 500 LLCs, and 0 tax returns on the LLCs. From an accounting standpoint alone, you can save a fortune. Now, I didn't say you don't have to pay taxes, but listen to this. This is what the Wall Street Journal calls the genius of the LLC. You can choose how to pay taxes. So if I said to all of you in here, you could choose how you want to pay taxes, wouldn't you say, well, I think I'll choose the way that saves me the most money? And yet most business owners do just the opposite, and so is he. So we had 4 properties over here. We ended up creating 3 LLCs for him because he put 2 of them in the same LLC. But again, they're filed in Indiana, disregarded entity, and they're owned by a management LLC. So when we came to him, here's how he was paying taxes. He had his S-Corp sitting up there. He had some income left over. He paid personal taxes. Then his accountant had taken his real estate, the business for the building, the leases and all that, plus the rental property, had added all that income to his personal property and had him pay taxes as an individual. So the guy had a multifaceted property, was paying the absolute top level of taxes. And we were surprised to find how many accountants thought this. Now, as a result of what we did here, his accountant changed his practice. So look what we did. It was pretty minor. We set up a management LLC, and the management LLC is filed in the state of Alaska. And you'll see the arrows where the equity connects to them. So think about this first. An attorney comes along to sue him, and the attorney says, oh, this is great. Like, the guy's a dentist, and he's got this building here where the dental practice is, and he's got 4 pieces of property over here. Man, I'm going to sue him. So the attorney pulls the deed, and he finds out that all of the ownership is in a management LLC, and the management LLC is sitting in the state of Alaska. And if the attorney sues him and wins the case, what happens? His people cannot have the properties, but they get the tax bills. And if they leave that lawsuit in the books, they get the tax bills every year until it's paid for. What does the attorney say? This is how you can expand a business. Now, I don't know how many of you are from here. For example, on the West Coast, the geography is very large. So you could have 1,000 stores in California and not cover the geography. But we have a lot of businesses we work with on the East Coast, up around Delaware, Connecticut, and all those places, tiny states. People traditionally either have properties or businesses in more than one state, or they operate across state lines constantly. And their fear is, well, if I go in this state, they're different lawsuits from this state. This stops that. This puts a screeching halt to it. But look how he's paying taxes. As a C corporation, remember I told you earlier that the C corporation has by far the greatest tax advantages in America? Let me give you just a couple of real simple instances. If you have, for example, if you're an individual or you have an S corp, you can deduct some of your medical and dental expenses. If you are a C corp, you can expense every penny of everything. The mileage back and forth to the doctor, all the premiums, all the deductibles, 100% of what you spend. Well, in today's world, that could be a lot of money in 1 year. But let me add another one. And you need to have some fun deductions once in a while. Most of you are aware that there's 3 areas of real estate for tax purposes. Your home gets some tax advantages. Investment property does very well, and a second home or vacation home does pretty well. Now, if any of you here have a vacation home, we're going to probably change that for you now, because how many of you knew there was a 4th category of real estate? Most of you accountants don't know. This is a 4th category of real estate, and everybody in here will know what it is when I tell you what it is. And by the way, companies like General Motors have hundreds of properties. You can have a property in any one of the 50 states and several of the Caribbean islands in this provision. This is called a corporate retreat. Have all of you heard that word before? We all have. So let me define a corporate retreat for you. And for those of you who have employees, this will be your brand new favorite lifetime tax deduction. A corporate retreat is a property that you purchase through your corporation for the use and enjoyment of your employees. And they would use and enjoy it if they could just find it. So usually the owners laugh and the employees go. But now it's a 100% expensable property. You're going to write off the mortgage, the interest. You're never going to have another vacation because you're going to have to go there to inspect the property. Every bit of it, maintenance, everything is a write-off. It can be a significant amount of money that you can save in a period of time, and you can have these in multiple states and some of the Caribbean islands. Again, the IRS is very specific. The reason I'm telling you this is these are just a couple of the deductions. So what if you went back, and I told you I'd give you a test to give to your accountant. What if you go home from this meeting today, you go back to your accountant and you say, look, let's take my 2017 taxes. Because unless you got my accountant, your taxes are already done. So you got your 2017 taxes, and you guys, your accountant prepared your taxes as an individual, whatever it may be. I want you to go back, take all of my income from last year, and I want you to recalculate my taxes as if I was a C Corp and take every allowable C Corporation deduction and tell me what it comes to. In his case, it lowered his taxes by 20%. His accountant now does this for everybody. But your accountant typically, if you have an S Corporation, your accountant had a tenured professor in college that said small business S Corporation, and your taxes are done as an S Corp every year. And your accountant's probably doing a very, very good job. But you're eliminating a tremendous amount of deductions. Where we really find this makes a point, there are people in here who say, you know what, if I had had this in place, I could have retired 10 years earlier. Because if you're paying a lot of money to the IRS that could have stayed in your pocket, it doesn't make any sense. So just a point to do it. It doesn't cost you anything, just have your accountant do it. If it gives you an advantage, if you're starting out in business, you're not profitable, it probably won't matter. But over time, businesses grow, the profitability increases, the assets are paid for, and all of a sudden the tax bill skyrockets. Well, if you can lower the tax bill, lower the tax bill. Any questions on this before I move on for a second here? Okay, I am going to stay afterwards to answer any questions you may have, so if you have private questions, you can do that. But I want to take a second here and show you how we've dealt with this over the years and how we've tried to keep people in line and understanding what they're doing. When we started, we dealt strictly with doctors. And the problem was that our services are very inexpensive, and so the doctors would all buy it, but they'd never do anything. And so I don't know how many of you guys have gone to seminars in the past, you bought something and it's still sitting on a shelf at home. It doesn't do you any good. So we learned these are the problems. People can come to this program, they can hear everything we've got to say, they can go, yep, I understand all of it, and then you get home and it's just a big fog. So say, well, how do we prevent that? How do we help you do stuff? So let me show you exactly what we do. We have a three-pronged approach. At the top there, when we started back in 1975, everything was paper. The legal forms, everything was paper. That was before they were doing CDs. And so people would buy this huge pack of information, and we were under this hallucination that they would go home and then do their legal stuff, and they wouldn't, even though it was pretty well laid out. So over time, we had to say, how do we find a way to get people to be able to do stuff where they're not intimidated by the process? So about 8 or 9 years ago, we came up with this legal software. This legal software is better than LegalZoom or any other legal software in America. It is designed for asset protection. It applies in all 50 states. You can use it for yourself, your family, and your business. So it's got unlimited use. You can see up here now, it's hard to tell, that's a living trust up there. The dark lines at the top, second to top there, that shows how close you are to being done. So say you wanted to do a living trust or a bill of sale or a C Corp or an S Corp, it'll ask you a question. Well, what's your name? You'll type it in there. What are you up to? Who are the partners and all that? When you're done, it will tell you what it is and tell you where it needs to be filed, if it needs to be filed. You know, a living trust doesn't have to be filed. The beauty of this is that there's no learning curve. All you do is answer questions. You don't see the legal documents till it's done. And my experience has been that legal documents by themselves are just really intimidating. So if you had to put one in front of you, fill it in, it's really tough. This way you don't have to do that. And again, you can use it for yourself, your family, and pretty much anybody who's around. But what really made a difference for us over here is this customized blueprint. We realized if you walk out of here today and you don't have a plan in mind, it's just not going to happen. You'll come back next week and go, yeah, it's good stuff, great stuff, but I didn't do anything. So we came up with this blueprint. And the blueprint is a really simple tool. It's about a 2 to 3 page questionnaire. You don't have this in your books, so don't look for it. So it's about a 2 to 3 page questionnaire, and it wants to know what you've got. Now, the way we're structured, really different from a typical law firm. We have a staff that works with the people that we work with. We work only through trade organizations by invitation, so we were invited to speak here. We don't do public seminars, we don't do motorcycle accidents or TV commercials. We're 100% asset protection for all 50 states. So you can call our office, we have a staff there that will deal with you. You can call them 10 times, 20 times, you can call them as often as you need. For those of you who have dealt with law firms in the past, one of the big problems is you call the office and the clock starts running, and it's too expensive, so you just don't call back. Well, in our case, we've got a staff there that'll work with you, feed you to the right attorneys, and get the information done for you. When you've got all the information together, they'll create a blueprint, and the blueprint is a comprehensive plan designed for you. Now, it could be, like this is a business in Tennessee, so it could be something like this, but your business will be unique. By the time you get the blueprint, you'll have had a lot of conversations. You'll already pretty well understand what you have. But then you'll have a consultation with the attorneys, and at the end of that consultation, for the first time in your life, you will thoroughly understand your legal life. And I will tell everybody in here, and everybody knows this, When you walked in today, there's probably not one person in here who thoroughly understood the legal side of your business. So this becomes, in my estimation, the most important thing we do. You're going to get the legal forms and all that stuff, but understanding what you've got is really important. Now, at that point, you've got three choices. You can say, look, I've got the software. You know, I needed this LLC or I need that. Can I just go ahead and create them? Sure, you can do that. You could say, well, could I take it to my accountant and have my accountant do it? You can do that. There's just no reason to. But if you have a very complicated business, like I did an ice cream group in Texas recently, down the southern part, I think San Antonio. And this guy had a family business, but he also had several ranches. They had about 50 rental properties. They had a couple of car washes and a Burger King. I mean, it was amazing. Well, he's way too big to just do one thing. He said, look, he said, I'm not going to do any of this. Would you guys do everything for me? If you want us to do everything, we'll just deduct the cost for this package and only charge you for what you need. So really just gives you all the flexibility. About 70% of our clients now create their own legal documents by themselves because it's so easy to do. So with that said, we'll give you free updates in future years. We also give a 30-day return, and I just want to mention this quickly. The 30-day return starts after you have the consultation. So you've already got the plan. You could literally say to us at that point, guys, I don't like you, I want my money back. You've already got your plan in place. We do that as a favor to the trade groups because the people here who book us, they're kind of putting their reputation on the line. So we've done this for years. No other law firm in America gives a money back guarantee, but we never get returns because our stuff is such high quality. So with that said, here's how we price it out. We're not a sales organization, so nobody's going to, if you filled out that little tab for the free report, nobody's going to call you later. Nobody's going to, we don't have a sales force to do that. So we operate like a university. If you went to a Florida Atlantic University and you want to take a course, you pay your tuition and your books up front. We work the same way, but we give you the guarantee. So we have two prices. The retail price is $49.95. And I would tell you, if you go to any attorney in the country and say, I want you to do an analysis of my estate and draft a plan, you'll spend more than $5,000. So I say, if we were doing that, that would be still a fair price. But that's a side of the company that works with major companies. We just did a package for the Building Industry Association, stuff like that. If you decide to buy it while you're here, you get a discount of $2,000. That makes the net price $29.95. And we do this for two reasons. One is we don't have a staff to call you. But we've also learned over the years. We also learned if you walk out of the room today and you don't start, you won't. It doesn't matter if you take the order form. It doesn't matter if you have the best intention. It just doesn't happen. So from our standpoint, it worked better. To kind of help you, we have a payment plan where you can pay $495 here today, which really removes the money from it. 5 payments of $500, no interest or finance charge. You still get the guarantee. You still get everything in here. So the bottom line for you is if it's worth $495 for you to start, then you need to do it. And the way it works is you fill out this order form. Here's the order form. It's a 2-part form. It's real simple. The back side lists all the fine print, all the stuff you get that's shown up on top there. The big part of the form is where you're shipping information. Then that dark line there on the left side, you can fill in the box and say, yeah, I want to pay the full price, or you can say, I want to do the $495, credit card or checking account, whatever. Then you just bring it back up to me. I will keep the original copy. I'll give you the back copy, give you a copy of the blueprint. You can literally start talking to the attorneys today if you want to. So I have a limited number of orders. Just want to repeat to you. If you decide to do this, you do need to fill this out here and bring it back up to me. So don't take the order form unless you're going to do it here, because it just won't do any good. So with that said, it's tax deductible as a business and an education expense. You get the 30-day return. You can plan for yourself and your family. Just return the form to me here. So, and again, guys, I apologize for going so fast through this, but in this short format, we had to combine a lot of information. Hope you got something you can take home with you. And even if you don't take advantage of our services, at least go sit down with your accountant or your attorney, make them be a little bit more efficient for you.